Hello and welcome to Options Guide TV. My name is Brian Overbeat, the author of The Options Playbook and your host for about the next 25 minutes here on Options Guide TV. All right, we're still in the heart of earnings. We got a lot of healthcare stocks that are going to be announcing this week. Few energy companies are tossing their name in the hat for the earnings announcements. Also, we have Uber on top of it. Not really sure what type of company I should say that is. I guess technology overall. We got DraftKings that are going to be announcing earnings. So we're getting out of the mega cap tech stocks and getting into the minutia of the marketplace. Before, we always end up with Nvidia at the end. Everybody sits and waits for Nvidia's earnings, and they're always at the end of the earnings season period, if you will. So COP, ConocoPhillips, is a stock that we actually did something a little different. We did a long diagonal trade in that as an alternative to a long call spread, in that we sold a shorter term option and bought a longer term option that contained the earnings. ConocoPhillips is announcing this Thursday, August 6th. They're going to announce before the open. And so by doing that, if you were down on the trading floor, you went diagonally on the quote board to see the quotes to make the market in that underlying stock. So the way that I look at it is we sold lower implied volatility. We bought higher implied volatility with the anticipation that as the earnings announcement approached, that implied volatility would even go higher than that on the way up. That actually worked out very well. So let's run to the Tradio Pro software, and we're going to look at the charts, because here's what we sold, and I'm going to zoom in this area. Here's the ConocoPhillips chart, and oil is down again today, and that's probably the main driver why ConocoPhillips is down, because it was looking really sweet heading into I should say on the close last week here, because here's what happened with ConocoPhillips is we sold the 122 strike, so it came up and touched that strike. So you could have gotten out at that point in time. I don't know if you would have had to been quick on the trigger finger to say that, well, it hit 122. That's exactly the strike that we wanted. Let's close it out. So if it comes back down, and now it's trading down a little bit today at 118.51, it looks like it's bounced back a little bit off of the open. So now what our goal was, we wanted that short-term option to expire worthless. And then we wanted to be able to either ride the long call into expiration or roll the position into a long call spread. So the diagonal is just a surrogate for the long call spread. It's trying to take advantage of what we expect to happen with implied volatility. The option contract that expires with the earnings report contained usually has implied volatility increase. As that earnings approaches, even though it might be high when we initially put it on, we expect it to go higher. And on the short-term option contract, we just want time decay to work for us. And hence, we want to be long a call option at a cheaper price than when we initiated the trade. And also gives us another opportunity to roll into a long call spread. So I'm going to do that today. Now, we could have closed it out on Friday and opened it new on Monday. And in hindsight, with the market being down, that would have probably been a better scenario to buy the option contract back on Friday for a nickel or a dime, and then sell the new option contract to go along with our long option as a roll, or so buy to close, sell to open would have been the trade. Okay, so now in our portfolio, if we look at COP right here, which is the symbol, we see the 121 strike call going out to August 7th expiration. We look at the options grid, we see that this is the earnings report. August 7th is that expiration date. We see that option contract. If we were to close it right now, we would sell it for 129. We could get out. We would be up a little bit on the position, but we really were planning on holding this going into the earnings report. And now what I'm going to do is try to lower this a little bit more. We're going to look at based off of this expiration, the expected move, if we just look at the in extrinsic value, or basically the midpoint, you take $2 plus over here, this is all out of the money options on the 118. We have $2.08 extrinsic, and we have $2. So we're going to call it $4.25. $4.25. So that's the expected move. We're at 121. $4 would get us to 122, 123, right in that range. We're going to sell something a little bit more out of the money. We're going to give ourselves 3 points here, and we're long the 121. We're going to sell the 124 and bring in an additional 50 cents, lowering our cost basis by 50 cents. So this is the order. If we were to just close it, try to take advantage of the implied volatility. The fact that the stock went down on the open today is not a good thing overall. Could have just closed it out for a fairly decent gain and not take the risk of the earnings report. But this was the plan the whole way. So we're, a lot of things about Options Guide TV is that we're just trying to learn. So what we would do now is sell to open our new position. And we're going to do this right now. We're going to sell the 124 strike call, hence turning this into a long call spread as we head into earnings, and assuring ourselves a profit, actually, by bringing in another 58 cents on the trade. Our cost basis, not quite as, I don't know if it's going to assure us a profit. I would have to go back and do the math on exactly what we received when we sold the 122 strike call. But here we go. Here's the 158. Here's the midpoint. The bid is 50. The ask is 67. And we're just going to send this down the trading floor. I would work it at 58, especially with earnings at 58 cents. I think that you've got a solid chance of trying to get that fill. We got a little thin on the open interest, considering we're going into earnings, but I would try to work that. But I'm going to make it, let's go 50. Let's just put it at 55. And we'll take 55 on this trade, and we're going to send that to the trading floor. Boom goes the dynamite. Order has been sent. So that is going to add to our portfolio, and we'll have a 121 strike call that we are long with the August 7th expiration, and then we'll have a 124 strike call that we are long with the August 7th expiration. It'll be we'll bring in another 55 cents. That will lower our cost basis. The maximum that it can trade for would be $3 on this trade. All right, so now going into the end of the week, here's some of the stocks. Like I mentioned, I think I like where the money is flowing in the healthcare space. So I don't mind looking at Eli Lilly, which is going to be announcing on Wednesday before the open. Uber is going to be an interesting one. Uber struggled a little bit recently. And then tomorrow we have McDonald's announcing before the open, and Caterpillar, and AMD is going to be announcing after the close tomorrow. So I think I like Caterpillar. It's gone too far too fast and has sold off because of that. But this is part of the AI spend. And if you look at this range right here, it's the top of this period of consolidation, filling the gap. We're right at the precipice here at 780, but the market is looking weak. We had the death cross, which is a strong word, but or a strong phrase, but we're looking at the 20-day crossing over the 50-day. Means a little bit more to me when it's the 50 and the 200-day that you're dealing with. So, but that is just showing signs of weakness. Our ducks aren't in a row. Got a solid area of support down here around the 200-day, and I should add some days so that's a little bit more prominent. And then we'll zoom in on this area at the 740 level. But right here we came down and we bounced. right off the 780, and we're back within this range heading into that earnings report. So Caterpillar's an expensive underlying. It always makes butterflies interesting. So highly anticipated they're going to have a strong earnings report. They are the benefit of the CapEx spend. The stock has sold off recently, so expectations, it's not necessarily buy the rumor, sell the news, right? We had the sell off. The same type of thing that we kind of, in Apple, we had that strong move up. And then on the top of the chart, I mentioned last week that if I was going to go anywhere with Apple, is I would rather get bearish on Apple. And Apple had a really good earnings report, but they came out and said that we can't get chips. And that's all it took for some reason to just sell off the stock. But you're going back to the olden days when Apple kept beating and, confirming forecasts going forward. The stock would always have a tendency to sell off. So we came right down to the 50-day moving average and bounced. Well, Caterpillar's already done that. So I think I want to get long Caterpillar. This is my bullish thesis that's behind it. Same type of move, but we've already had a pullback and we're in an interesting range right in here. So let's get long a open wing butterfly on an expensive stock. Now, the only thing I don't like is that the announcement is on a Tuesday. Kind of when we're doing the butterflies, I'd rather have less days to expiration on an expensive stock. We always talk about Amazon and they always announce on a Thursday and all you have is that Friday for that option contract to live. But we're going to do the August 11th expiration, which is we're going to do the August 7th expiration, which is 4 days away. I don't know why I was looking at that 11, but it's 4 days away on the August 7th expiration. And we're going to, go fairly wide on this. This will be a little bit more expensive than usual. So we're going to start by using that same expiration, August 7th. We're going to look at the 850 strike. We're going to go 20 points wide. We might even look at 30 points. So we're going to start at 20 points wide. We're going to sell 2 of these, and then we're going to buy 1 here. Now, this is the least expensive one. We're well within the expected move on Caterpillar. We're looking at a 28% chance of the stock at least reaching the 880 mark. By doing the butterfly 1 by 2 by 1, it means that this is 20 points wide. This is 10 points wide. It's got to trade for at least 10 points above and beyond 880. If we put 500 down on it, if that is the trade, that means that we're betting 5 to make 10 above 880, right? So, I should say maximum it could trade for would be 10. So we could make 5 on the trade above 880. If it goes out somewhere near 870 on the expiration, the concept is that this is 20 points wide and it could trade for 20 minus 5. You're talking about 15 in that instance, the maximum that you could make. I don't mind this. This is the $5 trade. I'll send it to the what if calculator, and then we'll come back and we'll look at a couple of different trades. But I think I want to go a little bit wider though. Willing to spend a little bit more and give myself a little bit more upside because the expected move here is around $60, $30, and over here $30. It's around 60 points. So we're talking 895. So this is well within the range. I like to try to spread it out a little bit wider, give myself a little bit more upside, spend a little bit more up front. And we always talk about a 1 contract basis. Obviously, everything changes if you're willing to do 2 or 3 or 4 or 5. But we just on Options Guide TV try to keep things simple and just look at a 1 contract or 1 unit basis. And so this entire unit is $500 plus any fees that you have to pay to get into the trade, which are very inexpensive at Tradier. Okay, so here we go. We're going to clear it. I'm going to clear the whole thing out. We're going to stay with the 850, and we're going to go 30 points wide. And then we're going to knock it down to 15. So let's do 30. And then halfway through would be 95, and we'll buy this one. And now we're 573. And we got 30 points here, and we have 15 points. So this could trade for 15 points above 895. Now, here's the difference. 73 cents. $5 versus $5.73. We're up 2% today at $18. Let's send to the what if calculator. And I think I'm going to make this one the official paper trade. I usually like, if we're doing something around earnings, I try to like to keep it around $300 or $400. A little bit more expensive underlying. So it's going to cost us a little bit more to put that trade on. And if you're looking at on a one contract or a one unit basis, click on these three, $5.83 is where it's at. This is where the underlying stock is. To start with, this is our profit and loss. Expect implied volatility to go in. And eventually, as Friday approaches, this green line that I'm highlighting with my arrow, my cursor, is eventually going to morph into what it looks like at expiration. That's part of the reason why I like to have a little bit of a shorter term frame than a longer time frame. To if you're doing these trades, vol comes in. If you're correct on the forecast, we do about the expected move, land up at about 880, right in that range. Now, remember, expected move doesn't have anything to do with direction. I keep forgetting, it doesn't mean that the market's going to go up. It's just saying that here's the over under. If it goes up or if it goes down, this is about what the marketplace thinks the move could be by that Friday expiration date. And that's what the long at the money straddle usually means. So we're on the 880 here. At 880, this trade could make 2,000. I'm going to put it right in the middle, $2,415. If we go up here at expiration, it could make $922. And our maximum risk here is, you can see it all the way down here. Oh, there it is too. $577.50 at expiration. So it took $5.50 is what it grabbed as we came into here. Gosh, it's already up to $675. Man, that jumped. So is the stock really moving? It always seems to happen whenever we do a show. We got a wide bid-ask spread, so I'm not really sure exactly where we can get filled at. I mean, this is extremely wide. There we go. 5 that came back down. I would work it at, I'd probably be willing to do $6 on this trade, $6. 575 is where the mid is at, but look at the bid is 65 cents and the ask is 10.85. And it's going to be a very liquid. I would expect to be able to get filled on these trades somewhere near the midpoint, coming into the floor around earnings with a three-legged trade. But I would definitely work this one. You don't just send it in, obviously, at market. You don't want to do that. But let's work the trade a little bit. I'm going to say $6 because it's a paper trading app. I might go as much as 610 to see if that's where the market is at, see if I can fill there in a real trading account. But right now I'm gonna leave it at $6. I think $6 is a fair price in this scenario. That's $600 per 1x2x1 open wing butterfly. So let's make this the official paper trade. Let me give you a quick read back here. All right, so we have Caterpillar. Caterpillar is going to be announcing earnings on Tuesday before the open, which is tomorrow. We're going to get bullish on Caterpillar by using an open wing butterfly. We're going to buy the 850 strike, sell 2 of the 880 strikes, and buy 1 of the 895 strikes. We're going to use the shortest expiration, which is this Friday, August 7th. Right now, we see the midpoint at $5.45. We're going to send this down to the trading floor at $6. And that means we're going to pay $600 per 1x2x1 butterfly plus any fees to put on the trade. And we're going to send this down to the floor. Boom goes the dynamite. Order has been sent. And we're showing the order working right now inside the account. So that's really going to be it for today's show. We're going to follow the COP trade heading into Thursday's earnings. ConocoPhillips has been very sensitive to the price swings. I expect a solid earnings report, and a lot of the analysts are expecting much the same. So we're going to ride ConocoPhillips into that earnings report in a long call spread situation. Friday, we had that expiration date on our option contract. That option expired worthless. That leaves us just long a call, as opposed to just being long the call option, which it isn't a bad position right now. We own it at a fairly decent price. We are going to go in and roll it into a long call spread. And then in Caterpillar, we're going to get bullish. Stock has been sold off a little bit. Opportunity with a solid earnings report. If they can meet and continue to raise, we see CapEx spending continuing to go up as opposed to go down in the AI space and the mega cap tech stocks. And they're going to use Caterpillar for energy, and also obviously the big equipment to build the data centers. So I still anticipate Caterpillar to be the benefactor. Long-term hold, definitely like Caterpillar. But I'm hoping that around earnings, this open wing butterfly can reward us for our speculation on their earnings report. All right, so we're going to come back on Wednesday, see how this trade did, and then we'll look at the ConocoPhillips trade one last time before they announce Thursday morning. That's it for this edition of Options Guide TV. See you Wednesday, 11 a.m. Eastern time for the next edition inside the Trade Your Hub, hub.tradeyour.com, if you'd like to learn more. Thanks for stopping in.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.